So, good afternoon again, ladies. This is the second PowerPoint for course companion 13, Fiscal Policies and Supply Side Policies. And this is running from page 17 in your booklets, in your course companions. And this is basically where we're looking at the Great Depression and the 2008 global financial crisis. And not comparing them exactly, but actually looking at some of the policies, some of the demand side policies that were put in place. As some of you will be familiar, the Great Depression happened in the 1920s, 1920s through to the early 1930s, and fundamentally it was probably one of the worst cases of recession that the world has seen, really. And so the next sort of worst scenario since the Great Depression was the 2008 global financial crisis, and the two are often compared and contrasted in terms of how serious they were, and they were both very serious in lots of ways, but actually quite significantly different in terms of the effect that they had on different parts of the world. So we're going to take a look at this almost as like an extended case study, and it runs from page 17 in your booklets through to let me just check the page. Through to around about 25. So there's some quite interesting articles, there's a bit of research that you might need to do, but as much as anything, it gives you a real interesting perspective, and also a potential case study that you could use should you need to demonstrate the application of demand side policies. It does include some monetary and some fiscal, but obviously as we've covered both of those now in terms of introducing them as concepts, then you shouldn't find that too difficult a stretch, I wouldn't have thought. So let's take a look at this as we go then. So first and foremost then, the Great Depression happened around about 1920s. There'd been a rising period of prosperity and confidence, but late in the 20s to 1928, the stock market again was looking like it was booming. Unfortunately, the Wall Street crash happened in the autumn of 1929, where US shares basically fell by a third of their value, caused many to lose their livelihoods, savings, and their homes, farms, etc. And consumer spending and consumer confidence absolutely went through the floor. There was mass unemployment. It was basically an absolute nightmare. And it was really the US that was most badly hit, but actually it had a serious effect on the rest of the world, as a phrase that I often use. When America sneezes, the rest of the world catches a cold. Well, to be honest, that was the principle here too. So during the 1920s, as you can see, 1920s through to 1930s, UK unemployment was running at a significantly high level. So it wasn't just the US that was affected by the Great Depression. There was significant knock-on effects with trading partners too, as you can see from the graph there in terms of the levels of unemployment, the percentage of people unemployed during that time period, right from 1918, which was obviously the end of the First World War, right the way through to, as you can see, a peak around about 1930, 31, 32, where we were talking about 15% unemployment. Bit of a recovery to 1938, and then straight back into the Second World War. So clearly, it was not a great scenario, not a great time to be an economist or a business person, because of the nature of the volatility of the market. So in terms of some of the issues then, in terms of trying to sort of break this down into the principles of how that might affect, how the impact of the impression, and what sort of impact did that have in terms of its effect on aggregate demand, etc. Well, effectively, if we take our long run average supply curve and assume that we were prior to the Depression at AD, then there was a massive shift, a massive fall in aggregate demand, and as you can see, the output at full employment was significantly reduced to the point where at AD1 we were talking about a reduction in price and also a significant reduction in output as a result of a lack of demand for goods and services caused by a massive fall in consumer confidence. During the 1930s, they reckon that consumer durables fell. The spending on consumer durables fell by nearly 20%. Well, clearly that is a significant change, which is obviously going to have an effect. So, in terms of what the policy responses were as far as this was concerned, and again, there's some more detail in on page 18, and it runs through to look at some policy responses to the Great Depression. But a number of economists had written books on the Great Crash, Galbraith being one, talked about reckless bank lending causing the issues, inappropriate government policy to deal with a number of the severe effects of this recession. And also, again, a little bit of detail on the difference between what a recession and a depression is. And effectively, if you like, a recession, as we've said before, is a slowdown in economic activity over 2 quarters, negative growth over 2 quarters, negative GDP growth over 2 quarters. Well, a depression, in this case, the Great Depression, was a sustained long-term downturn in economic activity in one or more of the economies. And effectively, if you think about the early 1920s, we were in the process of still trying to pay for the effects of World War I. UK trade was falling and business was struggling, and obviously the Wall Street crash caused a massive issue, plunging many areas into poverty, and unemployment rose significantly. So it wasn't just the US that was affected; it was us too. Okay, so during the 30s, probably not a great place to be. Britain struggled with high unemployment and poverty, although certain centres suffered significantly less. So on page 18, there are some tables that are actually, or a table is starting at the bottom of page 18, looking at policy responses to the Great Depression. So it breaks down fiscal policies, some classical responses to these sorts of scenarios, but also looks at the Keynesian response, which was the New Deal that happened in the US. And the difference was that in the first instance, both governments aimed for a balanced budget. So that clearly was a fairly major objective, trying to maintain a balanced budget. So trying to make sure that borrowing and tax revenue was significantly matched up. So trying to make sure that no a deficit nor a surplus was being achieved. And in essence, to try and achieve that balanced budget, both governments introduced spending cuts as tax revenues started to fall. And in 1931, in the UK, there was an emergency budget which cut public sector wages and unemployment pay by 10%, just like that, and raised income tax from 22.5% to 25%. So, on two fronts, not just the levels of pay, and obviously that then had an effect on disposable income, but also raising income tax, again having a significant effect on spending and obviously reducing aggregate demand as a result. So that was the classical response. Now, in the US, because obviously this went on for some time, that then we moved away from a classical response to this New Deal principle that the phrase was coined, where basically there was a huge public spending stimulus. So that meant an increase in government spending on infrastructure, construction, conservation, housing, reforestation, and many other areas, all pretty much initiated by Roosevelt in 1933. So there was a significant amount of pump priming provided by the government, and millions of jobs were created. There's a lot of debate as to whether this caused the recovery of the US economy or the Second World War, which followed. So in essence, clearly there were significant policy differences there as far as the US and the UK were concerned. So that was fiscal stimulus, if you like. But in terms of monetary policy, then in this instance, a lot of people claim that the interest rates were too high at the start of the Depression. in the 1930s, the Federal Reserve cut the interest rate from 6% to 4%, but then increased it again in order to maintain the value of the dollar. And during that time, the UK gold standard was abandoned in 1931, and that allowed the pound to fall by up to 25%, and obviously improved competitiveness, certainly in terms of exports. But interest rates, again, were significantly cut from 6% to 2%. And in some instances, clearly, that was about trying to stimulate more spending by reducing interest rates. Okay, so some quite interesting information there. So if we take a look at the next thing then in terms of the policy responses, and we talked about the monetary policy, and just based on the table that you've got on page 19. But again, there were issues in terms of trying to maintain the value of the relevant currency, but also trying to reduce interest rates to try and stimulate spending. And in terms of the exercises I'd like you to take a look at, and this is based on having a read around the subject, there are in fact 5 questions in total that I'd like you to take a look at, and there's some space for you to be able to complete those answers. So it ranges from drawing an AD and AS diagram to show the effect that budget cuts in 1931 and explain why Keynes criticised this policy. Also looking at trying to explain and trying to demonstrate an understanding of some of the things that were going on as far as both the Depression and specifically the Depression and the effect that had both on government policy, both in the US and the UK. Okay, there are some references to charts there, and those charts are in your booklet on page 20 and page 21. And there are also some really interesting video clips, so stock market crashes and bank failures, with notes specifically around the causes of the Great Depression. And that clearly is going to help you an awful lot to get your head around exactly what was going on during that time. There's a second link, which is a web link to study.com, and that's the Great Depression, the Wall Street crash of 1929 and other causes. So again, some views on what the role was of stock market speculation and the Wall Street crash. Well, by the very nature of it, was probably to do with some form of stock market speculation, but also the role of consumer credit. And you'd think, given the 30s and what happened during the 30s and the fact that it was such a nightmare, that our friends, the policymakers, might have actually done something slightly different when it came to the situation as far as the global financial crash was concerned. So often compared, the two things are, but in terms of and you're obviously going to be slightly more familiar with the 2008-2009 financial crash because we talk about it quite a lot, but to be able to compare the two, the Great Depression and the financial crash, is quite a useful exercise to be able to do. Okay, so some of the charts then, just showing you, in this case, real gross domestic income, or product rather, in this instance showing how that changed significantly. If you see that 1929 was our point at which our index was drawn up as 100, and you can see that during the time from 29 through to 33, we had a significant fall, over 20% gross domestic product fall, it fell in the US. If we take a look at economic growth in the 20s and the 30s in the UK, wasn't a great deal better in some ways. You could argue that maybe it wasn't quite so bad in that percentage of real GDP or the economic growth actually during that time, round about the 30s, fell by a certain amount, as you can see. I'm sorry, I didn't want to go to that point there. I do apologise. I'm going to come out of that and go back into our PowerPoint. So there's some quite interesting graphical information showing, in this case, GDP and the differences. But clearly, during the 20s and 30s, late 20s, early 30s, and into the mid 30s, there were significant issues around this whole process. Interest rates, so some information on interest rates, real interest rates during that time as well, and you can see the real interest rate and the bank rate vary significantly, which again, that's what we may expect. But again, interest rates and trying to stimulate more spending were effectively around about the mid to late 30s and down at 1937, where effectively there was a negative interest rate. So again, where there was the recession and the depression, significant efforts made to try, in this case, to stimulate spending by reducing interest rates using monetary policy. There is a very good clip. So once we looked at the Great Depression, I want you to take a look at pages 22 onwards, where we start to look at some of the demand side policies that were put in place in an attempt to address some of the issues of the global financial crisis, the 2008-2009 global financial crisis. So there's a really good video stimulus that you can take a look at on TeacherTube, so the Great Depression and the Great Recession, and essentially trying to compare how they were statistically, how did the governments react, what were the different views within the US, what sort of government intervention was included, and what sort of scenarios happened, and was it better or worse in 2008? Well, clearly, we feel that it may have been worse in 2008, but we weren't actually there in the 30s to see just how bad the Depression was. So in this instance, obviously, comparing the two, taking a look at that video is going to be a really useful process for you to look at. That link is on page 22 in your booklet, and obviously it will be on the PowerPoint that I'll put onto Teams once we've finished this narrated PowerPoint. So there's a video to watch there, and obviously some notes to take. Now, in terms of the next thing, there is, as you will be able to see if you take a look at page 22, a number of different things that both the UK and the US used in terms of fiscal and monetary policy to try to address some of the issues that were going on in the financial crisis. And it was clearly a very serious situation that we found ourselves in. So there were fiscal policy measures in the UK, there were the same in the US, but certainly fiscal policy, and then there was monetary policy as well. So one of the things that we talk about quite a lot when we're looking at policy responses is not just trying to use fiscal policy or monetary policy or supply side policy in isolation, but to use all of them in harmony to try to address whatever issue we might be facing in terms of the economy. So a number of things that were included. So the fiscal policy in UK in 2008 was a temporary cut in VAT to try to stimulate spending, a cut in basic rate income for income taxpayers, £3 billion worth of public investment brought forward. There's the car scrappage scheme, trying to actually encourage more people to buy cars again, and also a reversal of the policy to reduce the budget deficit through public spending cuts. So fundamentally, a whole range of government spending and taxation measures designed to try to stimulate demand. In the US, there was a $152 billion public spending spree, which was called the Economic Stimulus Act, and also significant amounts of money invested in 2009, $787 billion in public spending planned to try to help both the US, well, specifically the US in this instance, and certainly other countries that have been affected by the global financial crisis, to try to stimulate economic growth again. In terms of the monetary policy, then the MPC, the Monetary Policy Committee of the Bank of England, cut the bank rate from 5.75% in 2007 to 0.5 percentage point in March 2009. Again, in order to try to stimulate economic growth through further spending, and obviously making borrowing significantly cheaper was hoped that would actually stimulate more spending, borrowing, and also investment. In 2009, quantitative easing began with £200 billion authorised, and that was increased to £375 billion by 2012. To give some sort of context to that, the pandemic quantitative easing program, they reckon by the time that's finished, that will be somewhere near 850 odd billion that the government will be spending in order to try to address some of the issues that the pandemic has brought. So what else is happening in the US in terms of monetary policy? Again, very similar situation where the Federal Reserve cut interest rates from quite close to where we had ours at 5.25% down to between 0 and 0.25% by the end of 2008. There were 3 rounds of quantitative easing to boost the money supply, QE1, QE2 and QE3. And basically the Federal Reserve holds about 3 trillion and more assets as a result of this. So in that situation, clearly that was designed to try to stimulate significant economic growth by both increasing fiscal spending and also cutting the cost of money, so borrowing bank rates reduced, and also quantitative easing introduced in order to try to address the effects of the financial crisis, the great financial crisis, or global financial crisis. Some questions for you to take a look at on the next slide. What is the intended effect of a temporary cut in VAT? The intended effect of the car scrappage scheme, and also what were the drawbacks of these policies. So that might require a little bit of research. And then within your booklet there are more references. So we've got those references to the stock market crash, but also we've got some good articles, one from The Guardian, one from The Economist, talking about some of the issues around some of the policies that were put in place, and also what they were designed to try to do. So the first article is Keynes helps us through the crisis. It was an article in The Guardian back in 2016, and that actually gives an idea of the different options that were used in order to try to address some of the issues that were faced during that period of time. And it was a significantly difficult period of time. It was the worst recession that I've certainly lived through, although having said that, the pandemic might actually put that into the shade for a different set of reasons, essentially. Okay, so again, quite a nice article there, which will help you to answer those first 3 questions, and also the fact that some of these policies seem to work, seem to do the trick, but clearly in some cases, because they weren't necessarily orchestrated in a half decent way, that clearly meant there was a bit of a stop-go process, which obviously made it significantly difficult. The next article that is listed is from The Economist, and that's Much Ado About Multipliers, talking about fiscal expansion and also the principles behind that. Trying to what were the various governments around the world attempting to do using the effects of those fiscal stimulus, and also bearing in mind the fiscal multiplier and exactly how big an effect that might have. Okay, obviously we've talked about the size of the multiplier and how that might change for in various different conditions, but in some instances, clearly the level of multiplier is going to have a fairly significant effect when we're having a recession and trying to get out of it. So clearly that's worth considering and having a read through. Okay, there's another video for you to watch, The Fear of Boom and Bust, and that summarises the difference between Hayek's classical view and the Keynesian view, and I'll leave you to have a read of that or a flick through that, plus obviously take a look at the video, and then there are some questions to answer based on that video clip, the fear of boom and fear the boom and bust, which again summarises it quite nicely. Okay, so the next thing to take a look at then, well, in fact, that pretty much summarises the whole thing. So this was a relatively short presentation, but needs a little bit of time for you to just get your head around it and be able to then explain how, in this situation, two very significant difficulties, economic difficulties, the Great Depression being one and the financial crisis being another, were used, what sort of different types of policy we used, fiscal and monetary, in order to try to address some of the issues that were created by these significant shocks to the economy. So there are some other charts included here, which again will help you to understand in a wee bit more detail some of the issues around why fiscal policy might have changed in 2010. Well, around about 2010, as we can see. And again, I'll leave you to take a look at this. There is a significant drop there in terms of the amount of borrowing for a start, and clearly that is demonstrating that consumer confidence has obviously fallen significantly, and if consumer and investor confidence and businesses' confidence start to fall, that has a significant influence, in this case, on the amount of borrowing. And you can see that right the way from the point at which in 2009, 2010, we had significant amounts of net borrowing as a percentage of GDP. In this instance, clearly that fell significantly, and in this instance, obviously, as we got to the point where we'd spent significant amounts of money to try to address the issues of the financial crisis, well, at some stage that then has to be trimmed back in some way, and some of the austerity measures that were written about and commented about were brought in to try to control the level of borrowing as far as the UK was concerned. Now, again, another thing that you can take a look at here is drawing up a classical ADAS model and try to explain the attempts to stimulate aggregate demand and why they might have been ineffective in this scenario. Okay, and that basically covers that presentation. So that really covers the Great Depression and the global financial crisis. And when I say it covers the content that you need to do a little bit of research on. And hopefully you can then use that as example, should you need to, of how a government, or how two governments, the UK and the US, chose to try to deal with significant external shocks to the economy. So I'll finish there, and thank you for listening, and we'll catch up very soon.